What's up, everybody? Chris Hervishon here with SOAR, A Better Way CPA, coming to you with Facebook Live. And the title of today's show is Get in the Zone. Now, I don't know about you, but when I hear Get in the Zone, I think AutoZone. Obviously, they've got a very clever jingle. It's totally gets in your head. I found this meme on the internet. I thought it was absolutely hilarious, so figured I'd share that. But we're not actually talking about AutoZone today. We're going to be talking about opportunity zones. Now, what is an opportunity zone? An opportunity zone is an economically distressed area. And what happens is a municipality or a locality will come to the state and say, hey, our locality is an economically distressed area. We would like to get this qualified as an opportunity zone. They'll take that to the state. The state will then take that to the Treasury and try to get it qualified as an opportunity zone. Now, what does that do? Well, essentially that provides for tax breaks for economic investment that comes into those areas. So where did this come from? Well, it came from the Tax Cuts and Jobs Act. So this is a fairly new thing, the opportunity zone. Tax Cuts and Jobs Act was signed into law at the end of 2017. The regs on this particular piece of the Tax Cuts and Jobs Act just came out end of October 29th, I believe it was. So this is pretty new, and this is one of the most interesting tax planning strategies I've seen in quite some time. There's an opportunity for huge tax savings with these opportunity zones. So exactly how does this work? Well, essentially, if you've got capital gains, unrealized capital gains, meaning you bought something for, say, 20 bucks. The example that I used in the Facebook post was, say you bought Apple for 20 bucks back in like 2012 or whatever it was. Well, Apple or Facebook's somewhere around $180 a share now, so it's gone up 9x. Well, say you bought it in 2012, you're holding it now, you've got a 9x gain, you're not really sure what to do with it, you're either going to hold it or you're going to sell it. Well, you've got that huge built-in gain. Well, what do you do with it? Well, if you sell it, you take the cash and you go buy yourself a boat, you're going to pay tax on that gain, right? Well, the opportunity zone is a way to defer that gain, meaning you're going to pay tax on it later, and it's also a way to reduce that gain. So essentially, you take that gain, roll it into a qualified opportunity fund. Again, this is a high-level overview. The devil's in the details there on how to get an opportunity fund. It's easier than it sounds, let me put it that way. So roll it into the opportunity fund. The opportunity fund goes into these opportunity zones, these geographic areas that are economically distressed, and makes an investment in business, in a business in this opportunity zone, and then you hold it, right? So after year 5, and this is a pretty good timeline here, after year 5, the original capital gain, so that $160 gain that you had on Facebook per se, that gain gets reduced by 10%. So you're going to pay tax on less of the gain than what was actual. Year 7, you get a 15%. You get that additional 5 gain reduction. And then year 10, you get the 15% plus the investment that you made in the opportunity zone, that business or that investment that you made. That's going to be tax-free if you end up selling it. So huge opportunity there. Now, this is a really good example that I found from the Economic Innovation Group. I'm not going to read that to you, but I'll leave it up here on the screen for a second. If you want, go back to the video. It'll be up on Facebook. It'll be on YouTube. It'll be on my blog. Pause the video. Go ahead and read through this example. But it's a really good example that I found. And essentially, it's taking that gain and the effective tax rate is showing at 5.8%, which is really cool, right? Certainly less than you would pay normally. The most interesting thing I think about the opportunity zone is the potential to invest in real estate. Now, why real estate? Well, if you've heard me speak before, if you've seen some of my other videos, I talk about why real estate's a good investment. For one, if you do it right, you can get cash flow, so income, out of the investment, but it's also tax-free. Now, the reason why that is, generally speaking, is depreciation. You can take depreciation on real estate and the things that go into the real estate, the capital improvements that you make. So when you depreciate those, it offsets the income, right? And it's that the depreciation is basically a non-cash type transaction. I'm getting down to the weeds now, so I'll stop. But essentially, you can get cash flow that's tax-free from investment real estate if you do it right. Plus, in investment real estate, you're generally going to put 20% down on the property, right? And so you're leveraging your money up. So say you have a $200,000 gain unrealized gain. You go and you sell that Facebook stock, you get $200,000 in cash. You can go ahead and possibly roll that into $1 million worth of real estate, and then rent out those apartments or whatever they may be, homes, apartments, stuff like that. And it's essentially tax-free income for 10 years, right? And then, at the end of that 10th year, when you sell out of this investment, the gain that you have on the investment in real estate over the long term generally appreciates around 3% year on year. That's an average. It's not actual. So, take that for what it's worth. But you're going to get the appreciation on the real estate, which is going to be tax-free. You're going to get that cash flow for those 10 years, which is going to be roughly tax-free. And then also you're going to get a 15% reduction in that $200,000 gain. So huge potential for savings and a huge potential to make a lot of money. Now, last thing I will say about this, retirement accounts, 401ks, IRAs, yada, yada, yada. This is not a strategy for that, right? In a retirement account, you're not going to pay capital gains on the appreciation from that Facebook stock. So there's really no reason to do this inside of a retirement account. You're not going to want to do this inside of a retirement account. No. This is something that, if you have like a just standard brokerage account, you're going to want to do this strategy with those gains. The other thing I'll mention, capital gains inside of mutual funds, REITs, real estate investment trusts, those are going to be eligible for this strategy too. And you've got 180 days to put this strategy in place. So if, don't worry, if you sold that Facebook stock back in, I don't know, what do we call it, June of this year, you still got 180 days to roll that into a qualified opportunity fund. So a lot of time there, and gives you a lot of flexibility on finding ways to deploy that capital. That's it for me. Again, this was a very high level overview of qualified opportunity funds and qualified opportunity zones. I think it's one of the best planning strategies that's out there right now. If you want more information on this, please feel free to reach out to me, chris@betterwaycpa.com. That's my email. You can phone number's up there too, 843-608-0298. You can also see me on Facebook Messenger. Again, I've got a YouTube channel, LinkedIn, Twitter, all that good stuff. So feel free to reach out. Love to help you through one of these investments and using the strategy for tax planning purposes. So that's it for me. I will see you next week.